Watch this closely. Price breaks below the trend line with a huge bearish candle. Retail traders see the breakout and rush to sell. It looks perfect. A clean break, strong momentum, textbook price action, right? But it's all a trap. They enter late, placing their stop loss just above the last high, not knowing this entire breakout was designed by smart money. This move to the downside isn't the start of a trend. It's the setup for a reversal. Smart money uses the trend line break to trigger emotional selling, collect liquidity, and then flip the market in the opposite direction. This is where we enter, not with retail, but with smart money. In this video, I'll show you how to spot this exact structure, how to identify the final structure sweep before the reversal, and how to enter with precision using nothing but candlesticks. First, market structure. You'll learn how to zoom out, see the real direction, and stop getting faked by breakouts that aren't real breakouts. Second, impulse and correction. We'll break down the market into two phases. Impulse shows intent. Correction hides traps. Once you see this clearly, you'll stop trading confusion. Third, the trendline trap. This is where most traders get caught. A big bearish candle breaks the line, they jump in, right into the zone smart money is targeting. We'll flip that mistake into a setup. Fourth, structure liquidity sweep. Before price reverses, it takes out recent lows. This sweep is a trap. We'll show you how to spot it and avoid it. Fifth, the final structure sweep, the last push. It looks strong, but it's just smart money clearing out the rest before flipping direction. This is where we get ready to enter. Sixth, the lower time frame entry. We drop down and use candlestick confirmation to enter with tight stops, big targets, and smart money on our side. Seventh, real examples. We'll walk through actual setups from start to finish so you can apply everything with confidence. And lastly, a free bonus. Grab the Smart Money Entry ebook, free on our Discord or Telegram. Links are in the description below. Right now, you're looking at a clean chart, and what you see is price moving up, but not in a straight line. It pushes up, pulls back, then pushes up again, higher than before, then another pullback, and another push. This is called a higher high and higher low structure. We call it bullish market structure. Each time price makes a new high, it shows strength, and each pullback that stops at a higher point confirms the buyers are still in control. As long as this pattern continues, we stay bullish. Price starts off in a clear bearish trend. Lower highs, lower lows, the market is dropping. Then suddenly, it shifts. We start seeing a bullish trend form. Not just a few green candles, but actual higher highs and higher lows. To most retail traders, this looks like a full reversal. They think the market is done going down, and they start buying. But here's what's really happening. This temporary bullish trend is just a correction. It's not the start of a new uptrend. It's the market pulling back before continuing lower. And as price moves up, it sweeps internal liquidity. It takes out the previous lower highs one by one, triggering stop losses and trapping early buyers. Then, out of nowhere, price drops again. Fast, aggressive, back in the direction of the original bearish move. Now here's the key. Just because the short-term structure looked bullish doesn't mean the trend reversed. It was just a correction phase designed to trap. This is why you must understand structure inside structure. At first glance, it looks messy, unpredictable, but there's a simple rule that helps make sense of it. Before the market can reverse, it must take liquidity from the previous swing. Keep that in mind, and the chart becomes clear. Here, price is trending down, lower lows, lower highs, but then we spot something important. The final lower low, the last major push down before the reversal. What happens next? Price shifts direction and pushes up, breaking the previous lower high. That's our change of character. And notice something else. The bearish move down was slow, choppy, corrective. But the bullish move, it's sharp, clean, big impulsive candles. That's the clue. This entire downtrend wasn't a real trend. It was a correction inside a bullish market. And that's why we're now seeing price explode to the upside. By combining liquidity sweeps with structure, you start to see the market clearly, even when the chart looks chaotic. This is how smart money views the market, by waiting for key structural shifts and identifying the moment liquidity is taken before price moves. In the next chapter, we'll go deeper into this idea and show you exactly how to separate impulses from corrections using candles, speed, and flow. If you can master this one concept, you'll stop entering at the wrong time and start trading with smart money, not against it. So what's the difference? An impulse move is fast, clean, aggressive. It moves with strength, big candles, low pullbacks. It breaks structure and shows real intention. A correction, on the other hand, is slow, choppy. It moves sideways or gently against the main trend. It respects structure but doesn't break it. Now let's look at the chart. Here, price drops aggressively, big bearish candles. Momentum is clear. This is an impulse move down. down, then price pulls back. But notice, the pullback is slow. Small bullish candles, overlaps, not breaking any highs. That's a correction. Smart money isn't interested yet. They're waiting. Then boom, another drop, another impulse. This rhythm continues. Impulse, correction, impulse. We've talked about speed and strength. Now let's look at the structure of impulses and corrections. A true impulse is powerful. It doesn't just move fast, it creates clean separation in price. Let's take a bullish impulse as an example. Price pushes up, creates a higher high, then it pulls back. But here's the key. That higher low does not come back into the range of the previous swing high. It stays above it. No overlap. This creates a visible gap between the two moves, usually seen on higher time frames as a fair value gap. That gap is unfilled. It's the imbalance that shows strong momentum. This is what real buying looks like. Clean, dominant, no hesitation. Now compare that to a bearish correction. Here, price makes a lower low, but when it pulls back, it retraces into the range of the previous swing. Sometimes it taps the same price. Sometimes it overlaps or fully retraces. That's a red flag. It means the market isn't moving with conviction. It's just rotating, building liquidity. So here's the difference. Impulses leave gaps. Corrections overlap. One shows strength, the other shows indecision. And once you learn to see that, you can predict where price wants to go next. In the next chapter, we'll take this even further and expose how smart money uses these corrections to set traps, especially around trend lines. Before we move on, there's one more key detail. Even during a strong impulse, price will still pull back. It may be fast, strong, and directional, but it's not a straight line. So yes, even inside an impulse, we will see small corrections. But here's the difference. Those pullbacks are shallow and fast. They don't stay long, they don't overlap much, and they don't reverse structure. They're just mini pauses, like a breath before the next move. These micro corrections are important. Why? Because they often offer perfect entry zones for traders who understand structure. And now, let's switch to a real chart so you can see it all in action. We start with a clean, bullish trend. Price is making higher highs and higher lows. There's no price overlap. Each pullback creates a new leg. And we can even spot fair value gaps forming between swings. That's a clear sign of an impulsive move. Then suddenly, we get a change of character. Price breaks a higher low. Now we're moving down. But here's where most traders get confused. This new bearish move looks different. It's not clean, it's not fast, and price is trading back into the same levels as the previous bullish swings. In other words, there's overlap, there's hesitation. This tells us something important. This move down is not a real trend. It's a correction, setting up for the next big move. And that's exactly what happens. Price makes one more aggressive move down, sweeping liquidity, triggering stop losses. Then boom, a strong reversal. Large bullish candles drive price back up. Now we're seeing the real impulse start again, but to the upside. When you see this pattern clearly, impulse, correction, trap, reversal, you're no longer guessing. You're trading with confidence, and more importantly, with structure. Next, we break down exactly how this reversal trap is created, using trend lines, fake breakouts, and liquidity sweeps. Now, let's expose one of the most brutal traps in trading, the trendline trap. This is where retail traders feel the most confident, and smart money flips the market against them. Let's go through 5 real examples, so you'll never fall for it again. Example 1, trendline liquidity. Here, we see a clean rising trend line. Retail traders are buying every touch. They feel safe. Then suddenly, price breaks the trend line with a big move down. They panic and sell. But this is a trap, because just below that trend line is liquidity, stop losses, sell stops, and once price grabs them, it reverses hard to the upside. This isn't random, it's engineered. Example 2, equal highs as resistance. Here's a classic setup, 2 or 3 equal highs. Retail traders call it strong resistance. They sell at the top, confident it'll hold, but the market punches through, stops them out, then dumps. It's not a breakout, it's a liquidity grab. Smart money knows where your stop loss is, and they use it against you. Example 3, reversal patterns from YouTube. This one's everywhere. You see a double top, a head and shoulders, or a wedge. It looks textbook. Everyone's watching, and then the breakout happens. Big candle, volume, momentum. But that breakout is loaded with liquidity. Retail traders jump in, and price immediately reverses. These patterns don't fail because they're wrong. They fail because they're obvious. Example 4, expanded flat correction. This is one of my personal favorites. Here, we see price break both the low and the high. It creates confusion. Looks like a breakout in both directions. But this is actually an expanded flat correction. It's a smart money structure. And when you understand it, you can use Fibonacci extensions to predict the exact reversal zone. If you want to master this technique, join our private Discord. The link is in the description. Example 5, order block, liquidity, void. Now this one is advanced. Here, price doesn't respect anything. No order block. blocks, no fair value gaps, no structure. It just runs through everything, grabbing liquidity at every level. This is where retail traders lose the most because nothing makes sense except to smart money. They're not reacting, they're hunting. And that's the key takeaway from all these traps. Smart money doesn't follow structure. They manipulate it. They build confidence, trigger entries, then flip the market the other way. In the next chapter, I'll show you how to avoid these traps completely by mastering the final structure sweep before real moves begin. Now let's look at a real example on the chart to see how liquidity really looks in action. Here, we can see a clear correction phase forming, prices moving slowly, overlapping, and a trend line is forming perfectly. This is where most retail traders start looking for a sell setup. They see the trend line, they see price starting to break it with a big move down, and they sell. But let's look deeper. What's actually happening here is that price is likely completing a bigger correction, and this correction is building up to manipulate the internal low. So yes, it looks like a breakout, but is it really? Not quite. Because suddenly, price sweeps the previous low, grabs the liquidity sitting below it, and then reverses hard to the upside. That's the trap. And this is the structure you need to recognize. Impulse, correction, liquidity sweep, new impulse. Even inside internal price action, you'll always see these patterns. So in simple terms, price manipulated the trend line, completed the correction, and continued with the trend. If you learn to see this in real time, you won't fall for fake breakouts. You'll trade like smart money. And the best way to develop this skill? Backtest it. Go into your charts and study how these corrections form. The more you see it, the more obvious it becomes. And this time, if you combine everything you've learned so far, it becomes very clear how the market really moves. Right here, we can see an impulsive wave forming. It's fast, clean, and it leaves behind market gaps. Exactly what you'd expect in a strong impulse. Then, price shifts into a correction. It slows down, overlaps, and starts building structure. But pay close attention, because inside this correction, we can spot equal lows forming. The kind of setup retail traders see as support. But to smart money, that's just liquidity. And just like that, price manipulates the equal lows with an aggressive candle breaking below them and closing outside the zone. At this moment, most traders panic. They think this is the start of a bearish move. They enter sells. But watch what happens next. Price immediately reverses, and not slowly. It moves aggressively to the upside. This is a textbook trap. Smart money engineered the equal lows, triggered retail sellers, and used that liquidity to fuel a strong bullish continuation. And once you've trained your eye to see this, you'll never get tricked by these setups again. Now let's break down one last structure liquidity example, and this time it's from a chart that looks messy at first glance, but look closer. We can spot a clear breakout of a trend line. That's the first red flag. Then price starts pushing higher, but it's not impulsive. Instead, it's overlapping with every retracement. It's not gaining momentum, it's just correcting. And then suddenly, we get a clean, aggressive impulse to the downside. Price starts breaking through multiple swing lows from the correction, one after another. And here's the key detail. It's doing it with strong bearish candles, momentum, volume, and no hesitation. That's our final confirmation. This wasn't a bullish move, it was a trap. Retail traders saw the trendline breakout and slow grind up, assumed it was a breakout and jumped in. But smart money was just building up liquidity. Then they swept it and flipped the market. This is the kind of move that becomes crystal clear once you understand how structure, correction, and liquidity connect together. Now in the next chapters of this video, we'll break down the final liquidity sweep, show you how to analyze the higher time frame, then zoom into the lower time frame for sniper entries that deliver risk to reward setups as high as 1 to 20. Now let's talk about one of the most powerful setups in trading, the final structure liquidity sweep. This is where smart money makes their last move to trap traders and grab liquidity right before the real direction begins. So here are the key rules to identify it. Price must be aggressive when taking the liquidity. This means strong, fast moves, not a slow grind. Price should take out at least 2 or 3 previous swing points. This confirms that smart money is sweeping real liquidity, not just creating noise. And finally, once those key lows or highs are taken, we shift to the lower time frame to enter the market with low risk and high reward. But don't worry, we're going to break this all down step by step. Step 1. Start with the higher time frame. First, look for liquidity being swept. That means price is taking out key swing highs or lows from previous structure. In this example, we can see a bullish candle breaking above a previous swing high. That's your liquidity grab. Now here's how we use that candle. The high of that candle becomes your invalidation point. If price trades above it again, the setup is invalid. The close of that candle is also critical. We only want to look for sells above the open of that candle because that's where smart money likely initiated the trap. This gives us our framework. Step 2, move to the lower time frame. Once we identify the sweep and structure on the higher time frame, we go to the lower time frame for confirmation. Sometimes you'll find a clear break of market structure, BOS, but not always. Depending on which LTF you use, the structure may look different. So here's what to look for. Rejection candlesticks near the zone, bearish engulfing patterns, inside bars, any sign of rejection or shift in control. These give us precision entries with tight stop losses and extremely high risk to reward, even 1 to 20 setups. And don't worry, if this sounds like a lot to memorize, we've got you covered. You'll get all of these notes in a free ebook available in our Discord and Telegram. Links in the description below. Now let's apply everything you've learned. We're going to walk through a real example using the full method from liquidity sweep to HTF structure to entry confirmation on the LTF. Alright, let's go through a real example using everything we've learned. This is EUR/USD on the 15-minute chart. And yes, this is now our higher time frame for this setup. And here's the first thing I want you to understand. This strategy works on any time frame, whether it's M15, H1, or even the 4H and daily. It also works on indices, crypto, and Forex. Structure and liquidity are universal. Now look at this chart. We can see multiple swing highs being manipulated. Smart money is clearly pushing price above previous highs, only to trap breakout buyers and reverse. At the current price, we can see that price closed back inside the range after sweeping the high. That's our signal. Now let's mark the key levels. We place a line at the open of the candle that broke the swing high because this is where we'll be looking to go short, only above the open. Next, we set our invalidation level right above the high of the sweep. If price breaks that level again, the setup is invalid. And finally, we mark our take profit targets, which are also liquidity zones, previous swing lows, imbalance zones, or areas where retail traders set their stops. Now let's drop down to the 1-minute time frame. This is where the magic happens. And immediately we can see it. A visible break of market structure right after the sweep. That confirms smart money is in control, and now price is also trading above the open of the higher time frame candle that caused the sweep. That's our entry zone. Then look closely. One of our favorite candle patterns forms at the key zone. That's the green light. So we place our entry right at that rejection candle. Stop loss goes just above the invalidation high, targeting the next major liquidity level. In this case, if price moves in our favor, we have 1 to 29 risk to reward on the first trade and a clean 1 to 35 risk to reward on the second, both using the same structure, same zone, just split targets. And yes, price moved exactly in our predicted direction, aggressively. This is how smart money operates, and this is how you avoid retail traps while taking sniper entries. And remember, this is all happening on the 1-minute chart, which means precision, low risk, and fast execution. Here we can see in this next example on the Australian dollar versus USD that price traded above the equal highs and even manipulated above the main swing high. Notice how the bullish candle closes back inside the range. So when we move down to the lower time frame, we'll be looking to go short just above the close of that bullish candle. Our take profits will be set at the previous swing lows. Moving on to the lower time frame, which is the 5-minute chart, we can see that there hasn't been a break of market structure yet. However, the internal swing high has been manipulated. Whether or not we enter will depend on which candlestick closes in this area. Suddenly, we spot a bearish engulfing candlestick forming right after the manipulation. So, we place our entry and wait to see how the market reacts in this situation. And clearly, we can see that price moved in our favor. Moving on to example 3, we can see that price traded below the previous swing low and then closed back inside the range. This tells us two things. First, the previous support level that was broken can now serve as our first take profit. Second, we also note the previous swing high, which formed before price manipulated the swing low. This setup is on the gold 1-hour time frame. Now, we'll drop down to the lower time frame to see how price is likely to give us a precise entry. Now, moving on to the lower time frame, the 5-minute chart, we can clearly see multiple rejections after price closed back inside the range. Price initially moved in our favor, but there's one key issue here. The move to the upside was very corrective. And if you remember what we said at the beginning of the video, when price moves like this, overlapping, and choppy, it's usually a warning sign. It often means that price might stop us out before continuing in the intended direction. And that's exactly what happened here. Price kept going lower. This is actually helpful to see because sometimes we don't want to be in trades that move slightly in profit and then suddenly reverse to stop us out. Recognizing these corrective moves is another powerful way to manage trades more effectively. Here are a few bonus tips before we wrap up. Sometimes price will move aggressively without trading above or below the close of the candlestick. So always be aware of that. Traders, we've reached the end of the video. If you found this helpful, please consider subscribing to the channel and hitting that bell icon so you never miss an upload. Thanks for watching, and I'll see you in the next one.